Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. I'm your lead analyst. Today, we are putting S&P Global under the blowtorch. On the surface, this company just posted some absolutely stellar numbers. We're talking 8% revenue growth, a 14% jump in adjusted earnings. I mean, these are numbers most CEOs would dream about. And yet, the market didn't just dislike the report, it took it out behind the woodshed. A brutal, swift takedown. So our job today is to figure out what in the world Wall Street is seeing that the headline numbers aren't telling us. Is S&P Global a financial fortress built on solid granite? Or is it just a house of cards, one strong gust of wind away from total collapse? Let's get into it.
A knockout year? Yeah, I'm not so sure. The market certainly didn't buy it for a second. I'm the market skeptic, and my job here is to ask the tough questions you're probably already thinking. How on earth does a blue-chip behemoth, a pillar of the entire financial system, post those kinds of growth numbers only to have its stock get absolutely annihilated? You see, a drop of nearly 15% in pre-market trading, that's not just a bad day at the office. That is a massive vote of no confidence from the people with the most skin in the game. To me, this screams that the market smelled something rotten in these results long before the rest of us had our morning coffee. The real story here isn't the shiny numbers they just posted. It's the market's violent, clear, and frankly terrifying rejection of them.
Exactly. And that's the fundamental conflict, the paradox that we're going to dissect piece by piece today. First, we'll put the company's strong performance and the market's brutal reaction head to head. Then, we'll get to work building the bull case, what we're calling the financial fortress, where we'll examine the massive load-bearing pillars that are supposed to be holding this company up. After that, we're going to go looking for the cracks in the foundation, the exact weaknesses the bears are betting against. Then, we'll pop the hood, go under the hood, and put each and every business segment through a rigorous stress test. And finally, after all that, we'll deliver our verdict. Is this 15% plunge a golden, once-in-a-decade buying opportunity, or is it a trapdoor just waiting to spring on unsuspecting investors? Let's dive in. Okay, let's just set the stage here with the raw, cold, hard data. The full year 2025 performance was, by any traditional metric you want to use, incredibly solid. They even hit the high end of their own guidance. They did exactly what they told the street they would do. But then, you look at that stock chart. The reaction was immediate, and it was absolutely ruthless. A drop of nearly 15%, down to $378.04, all before the opening bell even rang. Now, that's not a correction. That's not a pullback. That is a verdict being rendered in real time. The market is screaming at the top of its lungs that the past is completely irrelevant, and the only thing that matters is the future. So the real question is, what's lurking in the shadows that has Wall Street this spooked? That is the multi-billion-dollar question, isn't it? And before we go exploring those dark shadows, we have to understand the structure itself. We're going to build the bull case brick by brick, just to see how strong this financial fortress really is. We need to examine the core pillars of this thing, the raw revenue that powers its growth, the massive, almost unbelievable returns it provides to shareholders, and the sheer time-tested durability that has allowed it to withstand countless market storms. This is the foundation that the bulls believe the market is foolishly, and perhaps temporarily, overlooking in its panic.
So, let's start with the cornerstone, the absolute bedrock, top-line revenue. For the full year 2025, S&P Global pulled in a cool $15.3 billion. That's a solid 8% increase from the $14.2 billion they posted back in 2024. Now, this isn't some sleepy company that's just treading water. This is a company that's actively growing its top line, which is the absolute lifeblood of any business. We're talking about more than $1 billion in brand new revenue in a single year. This growth is the first and maybe the most fundamental piece of evidence that this fortress isn't just standing tall, it's actively expanding its walls.
Right, now, what's truly mind-boggling about this slide is what they actually did with all that cash they generated. The company returned a staggering 113% of its adjusted free cash flow directly to shareholders in 2025. Let me say that again, 113%. That breaks down to $1.2 billion in dividends and a massive $5 billion in share buybacks. Think about that. This is a company that's not afraid to put its money where its mouth is. By returning so much cash, actually more than they even generated in the period, management is sending a clear, loud, powerful signal to the market that they believe with absolute conviction in the company's future earnings power and its financial stability. This is some heavy-duty reinforcement for those fortress walls.
And this slide right here brilliantly illustrates the company's insane durability. 53 consecutive
years of dividend increases. Just let that sink in for a minute. This company has increased its payout to shareholders through the dot-com bust, through the 2008 global financial crisis, through a global pandemic, and through countless recessions and market shocks in between. This makes it a dividend aristocrat, an elite members-only club reserved for only the most resilient and reliable companies on the entire planet. This isn't just a company that's been around for a long time, it's a company that has a proven, decades-long track record of consistently delivering value to its owners, which is the ultimate test of a company's real strength.
So the really crucial point here, connecting back to that powerful top-line growth, is that this strength wasn't just coming from one place. I mean, look at this full-year revenue chart. Every single division grew. Market Intelligence, their largest segment, up 6%. Ratings, the historical core of the business, up 8%. Energy, up 7%. Mobility, up 9%. And then you have Indices, the star performer, up a massive 14%. This is not a company that's being propped up by one hot product line. No, this is broad-based, diversified strength across the entire portfolio. Each segment is a pillar, and every single one of them got stronger in 2025. This is a company that's firing on all cylinders, which, let me tell you, is a rare and incredibly valuable thing in today's market. Okay. A beautiful fortress, I get it. Granite walls, 53 years of history, every division humming along. But even the strongest fortress in the world can crumble to dust if the foundation is cracked. And that 15% drop, well, that tells us the market isn't standing around admiring the architecture. It's on the ground with seismic sensors, looking for the structural weaknesses. So let's put on our hard hats and go searching for those cracks. Because the market's reaction wasn't some emotional outburst. It was a cold, calculated response to what it perceives as real risk. It's time to find out if this fortress is as strong as it looks, or if it's just a house of cards waiting for a stiff breeze.
And there it is, the first and by far the most significant crack in the armor, the 2026 guidance. You see, the company projects adjusted earnings per share somewhere between 1940 and 1965. But Wall Street was expecting nearly $20 a share. Now, that might seem like a small difference, just a few percentage points, but for a company of this size and stature, that's a chasm. The market is a forward-looking machine. It only cares about what's next. And when it sees a company signaling the slowdown, it does not wait around to see what happens. It sells first, and it asks questions later. This single data point is the primary justification for that massive sell-off, period. And then, to add insult to injury, there was the slight miss in the fourth quarter itself. They reported adjusted EPS of $4.30. The Wall Street consensus was looking for $4.32. Now, is 2 cents a disaster on its own? Of course not. It's a rounding error. But when you look at it in the context of that weak forward guidance, well, it validates the entire negative narrative. It suggests that the slowdown isn't just some future projection. It might already be here. It was the final nail in the coffin for a stock that was suddenly standing on very, very shaky ground.
And believe me, it's not just the guidance. When you actually dig into the earnings call transcript, you find the specific reasons why that guidance is so weak. These are the headwinds they explicitly called out themselves. Softness in bank loan volumes that hits their core businesses right where it hurts. A 3% decrease in their high-growth energy transition revenue just in the fourth quarter. A specific $3 million hit from sanctions. They flat out warned that billed issuance, a key metric for their ratings business, is facing some really tough comparisons next year. And they flagged volatility. These aren't just abstract boogeyman risks. These are specific, identified problems that they know are coming. The market is a forward-looking machine, and when it sees a company sailing into a perfect storm of headwinds, it doesn't wait around. It sells. Okay, so we've got the bull case of the solid-as-a-rock fortress, and we've got the bear case of these emerging and, frankly, very worrying cracks. To find the truth, we need to go deeper. We need to go under the hood. We're going to put each and every one of these business divisions under the microscope to see which ones are really pulling their weight and which ones might just be holding the entire company back. By stress testing each individual component, we can finally determine whether the whole is stronger than the sum of its parts, or if a few weak links are threatening the entire enterprise.
All right, this lays out the battlefield perfectly. Let's break it down line by line so we can see the tug of war in action. First up, ratings. Now, 12% growth in Q4 was incredibly strong, no doubt. It was driven by a 28% surge in billed issuance. That's basically the volume of new bonds and loans getting rated. But the concern you flagged, the con, is very real. Soft bank loan volumes. That's a persistent headwind that's not going away. Next, you've got indices up a monster 14%, an absolute beast of a quarter, driven by fees linked to rising market assets. But the immediate question, the one every skeptic is asking, is can that possibly last? Then there's market intelligence with a respectable 7% growth, built on sticky, predictable subscription revenue. The problem there? The volatility in their volume-driven products. Energy grew 6%, which is solid, but you see those direct hits from sanctions and that slowdown in energy transition. And finally, mobility, a healthy 8% growth, but it comes with a massive asterisk hanging over it, that impending spinoff. As you can see, there's a lot to like about this company, but there are also some very real concerns that investors need to be paying close attention to.
Yeah. Let's just focus on that star performer for a second, the indices division, growing at a blistering 14%. This is the engine that's really pulling the whole train right now. It's fueled by the unstoppable rise of passive investing and exchange-traded funds, or ETFs. It's a fantastic business with incredible margins. But, and this is a huge but, it's also the segment most directly tied to the health of the financial markets. So the bear case here isn't that it's a bad business. It's not. It's a great business. The bear case is that these are cyclically high numbers. The market is a forward-looking machine, and when it sees a company relying this heavily on a cyclical business to drive its growth, it gets very, very nervous. And when the market gets nervous, it sells.
And, as we talk about the future, we have to address the elephant in the room with the mobility segment. It grew a healthy 8%, driven by well-known brands that you've probably heard of, like Carfax. But S&P Global is planning to spin this entire division off into a brand new separate company in the middle of 2026. Now, a spinoff is supposed to unlock value by allowing each company to focus on its core business. In this case, S&P Global becomes a more focused, financial data pure play. But it also means they lose a solid, reliable growth engine. And you know what the market hates more than anything? Uncertainty. And when it sees a company that's about to undergo a major transformation like this, it gets nervous. And when the market gets nervous, it sells first and figures out the details later.
So that brings us to the final judgment, the moment of truth. We've examined the impressive, seemingly impenetrable fortress, and we've inspected the worrying cracks in its foundation. We've stress-tested every single component under the hood, so now it's time to weigh all the evidence. On one side of the scale, you have a long history of durability and broad-based growth. On the other side, you have cautious guidance and a very clear list of headwinds on the horizon. So the ultimate question we have to answer is this. Is this a rare chance to buy a world-class company at a steep discount, or is it a clear sign that its best days are now behind it?
Looking at these two columns side by side really brings the conflict into sharp focus. The bull case, there on the left, is all about proven quality and history. You don't build a 53-year dividend streak by accident. That comes from having a dominant, almost monopolistic market position. The bull argument is that the market is having a myopic, short-sighted panic attack over a slight guidance miss, and it's completely ignoring the rock-solid foundation of the business. Now, looking at the right, the bear case argues that guidance is everything. It's management's direct signal to you about what's coming down the pike. The bear argument is that the market is a forward-looking machine, and it's telling you that with all these headwinds in key areas, this company's best days of growth are in the rearview mirror. It's not a panic, it's a rational repricing based on new, weaker information about the future.
And that's what it all comes down to, right? Is the market's 15% price cut an irrational sale on a premium asset, giving you a rare opportunity to buy into a fortress at a serious discount? Or is the market, in its collective wisdom, accurately telling you the truth, that the fortress isn't nearly as impenetrable as its history suggests, and that the cracks in the foundation are real, and they are spreading? The answer to that single question will determine whether you're buying a bargain or a lemon. The choice is yours. For Iron Financial, I'm the lead analyst.
And I'm the market skeptic. Thanks for watching.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.